Want to get your take not only on the rally we're seeing in the market right now, but that we have been seeing as of late. What do you think is priced in here?
Well, I think that there's more priced in than is going to happen in the short term from a opening the economy standpoint. The markets have been very enthused over the last 2 to 3 weeks because we've seen a peaking in the cases and we have an open-ended fiscal and monetary backstop behind us. That's great, but in order to open the economy, we need to have confidence. And the way to create confidence on the part of employees and consumers to get people back at work and to get consumers back in stores is to have testing and to have therapeutics. We are at the very beginning stages of really building out an adequate testing capability. Even when we talk about the amount of testing that we have today, a lot of that testing is still 3, 4, 5 day results. That's not going to cut it for the kind of certainty that we need in order to get employees comfortable with who they're working with or to get people back in stores. And in terms of therapeutics, we're seeing today a really nice rally in the market. And quite frankly, it's the first time that we've had any hopefully hard evidence, hopefully it's indicative of hard evidence to come, that our therapeutic toolkit is going to actually start to come together to create some level of confidence for people that when they fall ill, if they fall ill, that they're going to be okay.
So talk to me about how this is translated to changes in your own portfolio.
Yeah, so we maintain an underweight position on risk. We don't see a V-shaped recovery. We see a U-shaped recovery. And so we think the markets are meaningfully ahead of themselves. If we look right now at valuations relative to 2021, not 2020, but 2021, assuming $150 per share, we're actually higher than peak multiples before COVID hit. And so the risk clearly remains to the downside, which is why we remain underweight. And within the equity portfolio, we have maintained an overweight on technology because technology companies actually, in many regards, as we've seen, are less levered to the bricks and mortar economy, which is being shut down, and are actually higher quality companies, which is across all sectors where we think investors should be looking for companies that have really great management teams, really low levels of debt, really persistent earnings, and high quality dividend payers. And you see those to some degree in all sectors. You see them more obviously in staples, utilities, but you also see them in tech and you see them in financials. We actually like the broad, diversified, big money center banks that reported earlier in the week. We think that they have a lot of opportunity to do well here. We'd stay away from deep value.
Got it. And when you say deep value, I'm assuming you mean energy, which has been and continues to be such a big focus.
Yeah, energy, basically any kind of companies that basically don't have the kind of quality attributes that I just talked about and whose principal attraction is that they're really inexpensive on a multiples basis, but they don't have the persistence of earnings in a situation where their core business will be shocked and they don't have a strong balance sheet behind them. And those are areas of the market that have lagged, frankly, for years, and we don't expect them to continue to turn the corner here in this kind of environment. The reason I point that out is because typically when you go through the beginning stages of a bull market, and we're up almost 30% from the lows, you see value rally really hard. This is such a different kind of cycle than we've seen in the past. We're just not seeing those kind of value names be able to take advantage of an economic resurgence because we're really not seeing an economic resurgence. We're only seeing a resurgence in multiples in the equity market, but it's not predicated on a real economic renaissance in any way.